This guide focuses on how to quantify a client's life insurance needs and recommend a suitable policy. This process involves assessing the risk, analyzing the financial needs, and then making a specific recommendation. The concepts are illustrated using the case study of Derek and Becky. Assessing the client's risk when conducting a life insurance needs analysis, a life agent should first evaluate the probability, severity, and duration of the risk for the client. This can be organized in a risk assessment matrix. Every person's risk matrix is unique and changes over time. For example, a healthy 30-year-old man with a young family has a low risk of death, but the financial impact of his death would be high. In contrast, an 85-year-old single woman with no dependents has a high risk of death, but the financial impact would be low. Assessing the client. Current age and gender. The odds of dying increase with age for both males and females. However, except for old age, females generally have lower odds of dying than their male counterparts. Sometimes, expressing this probability in odds can help a client visualize the risk. For instance, a 30-year-old man has a 0.104% chance of dying before his 31st birthday, which translates to odds of 1 in 962. The agent can emphasize this risk by comparing it to a relevant number, such as the number of students in a local high school. For Derek, who is 47, the probability of dying before his next birthday is 0.228%, or 1 in 439. For Becky, who is 38, the probability is 0.066%, or 1 in 1,515. Another approach is to present the probability of death before a certain age, such as 65. A 30-year-old man, for example, has about a 12% chance of dying before age 65, which is 1 in 8 odds. An agent could ask their client to imagine 8 friends of a similar age and point out that, statistically, one of them will die before age 65. Personal and family health history. A person's health history and a family history of diseases with a genetic component can increase their probability of death. For example, Derek's father and 2 uncles were diagnosed with type 2 diabetes before age 50, and both uncles died in their early 60s. Since Derek is overweight and predisposed to the same disease, his odds of dying are higher than the average Canadian. Lifestyle risks. Lifestyle choices can also affect the probability of death. These include smoking, having a stressful job, excessive drinking, a history of driving infractions, frequent travel to developing countries, or engaging in hazardous activities or hobbies. Derek, for instance, smokes 10 cigarettes a day, which increases his risk. Becky does not smoke, and neither of them has risky jobs or dangerous hobbies. Financial impacts of death. An agent should help the client understand what their death would mean financially for their family. The biggest financial impacts usually involve loss of income if the person is employed and supports their family, the cost of replacing a primary caregiver, the need to repay debts, such as a mortgage or car loan, income taxes from the deemed disposition of capital property at death. In Derek's case, the biggest impact of his death would be the loss of his $8,400 monthly after-tax income. His death could also result in his $309,912 mortgage and $41,000 car loan becoming due in full. Additionally, the transfer of the cottage to his children could create a $175,000 tax liability. For Becky, her death would require Derek to hire a caregiver for their children, so he could continue working full-time. Financial impacts of death. An agent should help the client understand what their death would mean financially for their family. The biggest financial impacts usually involve loss of income if the person is employed and supports their family, the cost of replacing a primary caregiver, the need to repay debts, such as a mortgage or car loan, income taxes from the deemed disposition of capital property at death. In Derek's case, the biggest impact of his death would be the loss of his $8,400 monthly after-tax income. His death could also result in his $309,912 mortgage and $41,000 car loan becoming due in full. Additionally, the transfer of the cottage to his children could create a $175,000 tax liability. For Becky, her death would require Derek to hire a caregiver for their children, so he could continue working full-time. Duration of risk. The agent also needs to determine how long the financial risk of death will be a concern. While the risk of death is always present, the financial impacts may only be a problem for a specific period. Most of Derek's financial obligations have a limited duration. His spousal support of $500 per month to his ex-wife Susan will continue until she turns 65, which is in 21 years. His child support for Jordan of $1,000 per month will last until Jordan turns 19, which is in 11 years. The mortgage has 18 years remaining. The car loan will be paid off in 6 years. However, the tax liability on the cottage will only occur upon his death, and the timing is unknown, so this risk could be a concern for 40 or 50 years or even longer. This tax liability is also likely to increase over time as the cottage appreciates. Financial impacts of death. An agent should help the client understand what their death would mean financially for their family. The biggest financial impacts usually involve loss of income if the person is employed and supports their family, The cost of replacing a primary caregiver. The need to repay debts, such as a mortgage or car loan. Income taxes from the deemed disposition of capital property at death. In Derek's case, the biggest impact of his death would be the loss of his $8,400 monthly after-tax income. His death could also result in his $309,912 mortgage and $41,000 car loan becoming due in full. Additionally, the transfer of the cottage to his children could create a $175,000 tax liability. For Becky, her death would require Derek to hire a caregiver for their children, so he could continue working full-time. Duration of risk. The agent also needs to determine how long the financial risk of death will be a concern. While the risk of death is always present, the financial impacts may only be a problem for a specific period. Most of Derek's financial obligations have a limited duration. His spousal support of $500 per month to his ex-wife Susan will continue until she turns 65, which is in 21 years. His child support for Jordan of $1,000 per month will last until Jordan turns 19, which is in 11 years. The mortgage has 18 years remaining. The car loan will be paid off in 6 years. However, the tax liability on the cottage will only occur upon his death, and the timing is unknown, so this risk could be a concern for 40 or 50 years or even longer. This tax liability is also likely to increase over time as the cottage appreciates. Other risks. An agent should also consider other risks that could be covered by a life insurance rider or could interfere with the client's ability to pay premiums. Risk of illness or disability. The risk of becoming disabled for 3 months or longer is significantly higher than the risk of death for all age groups. Disability can impact a family's finances as much as death if the disabled person can no longer earn an income. If a client lacks adequate disability coverage or an emergency fund, they may want to add a waiver of premium benefit or a dread disease rider to their life insurance policy to help them keep the policy in force. In Derek's case, he has a generous disability policy through his employer and isn't interested in these benefits. Risk of unemployment. The agent should assess the stability of the client's income to ensure they can pay premiums. If the client's income fluctuates, a universal life (UL) policy, which offers some flexibility in deposits, might be a good option. Insurance needs analysis. 2 main approaches are used to calculate life insurance needs: the income replacement approach and the capital needs approach. Insurance. Capitalization of lost income. The amount of insurance needed is determined by calculating the capital that would need to be invested to generate the lost income. The formula is capitalized value equals annual income / rate of return. For Derek, with an annual income of $100,800, $8,400 per month, and a 5% rate of return, the capitalized value is $2,016,000. This approach, also known as capital retention, tends to be high because it assumes the principal, death benefit, remains intact and only the investment income is used. This ensures the income stream can last indefinitely. Impact of investment returns, inflation, and income tax. This simple approach can be refined. A conservative interest rate should be used to protect against changing investment returns. It also doesn't account for income taxes or inflation. Accounting for income taxes. While life insurance proceeds aren't taxable, the investment income generated from them is. If the lost income is expressed as an after-tax amount, the interest rate used should also be an after-tax amount. For Derek's after-tax income of $100,800 and a 25% average tax rate, the after-tax rate of return is 3.75%, 5% times 1 to 25%. Using this, Derek would need $2,688,000 in life insurance to replace his income, $100,800/3.75%. Accounting for inflation. The model assumes income is fixed, but it usually increases with inflation. This can be addressed by using an inflation-adjusted rate of return. For a 5% return and 2% inflation, the inflation-adjusted rate of return is 2.94%. This would increase Derek's insurance need to $3,428,571. Accounting for both. To account for both, you use an after-tax and after-inflation rate of return. For Derek, with a 3.75% after-tax return and 2% inflation, the rate is 1.71%. This raises his insurance need to $5,894,737. Weaknesses. The income replacement approach is simple, but it might not accurately reflect a family's actual needs. Replacing 100% of lost income in perpetuity may be more than the family needs, or it might not be enough. It also doesn't consider the desire to create or protect an estate. Capital needs approach. This approach is usually more beneficial. It identifies all income and capital needs resulting from death and converts them into a lump sum. It starts by comparing the surviving family's income sources with their expenses to find any shortfall. Income earned by survivors. This includes employment, pension, or investment income, as well as government benefits. Becky does not work but would be eligible for a Canada Pension Plan, CPP, survivor benefit of $651 per month, while her children Anya and Robbie would each receive $258 per month as children of a deceased contributor. Ongoing expenses. The next step is to determine the family's ongoing expenses after death. Expenses may increase, e.g., childcare, decrease, e.g., food, clothing, be unaffected, e.g., home heating, or be eliminated entirely, e.g., the deceased's golf membership or mortgage payments if paid off. Derek wants all debts paid upon his death, so Becky would not have mortgage or car payments. Income shortfall. If income is less than expenses, a shortfall exists. The formula is income shortfall equals expenses, income. Factoring in the CPP benefits, Derek's family would face a monthly shortfall of $2,983. Capitalization of income shortfall. The next step is to determine the capital needed to fund this shortfall. Capital retention method. If the goal is to preserve the capital, the formula is capitalization of shortfall equals annual shortfall / investment return. Using the after-tax, after-inflation rate of return of 1.71%, the capitalized value of the family's shortfall would be $2,093,333. Capital drawdown method. For needs with a limited duration, a more practical approach is to multiply the annual shortfall by the number of years it is expected to last. For example, Derek wants Becky to not have to work until Robbie turns 18. Using this method, the capital needed for the family shortfall over 18 years is $644,328, $2,983 per month x 12 months x 18 years. The same method can be used for other obligations, such as the $126,000 for spousal support over 21 years and $132,000 for child support over 11 years. Capital needs analysis. This step identifies other lump sum needs that would arise from death to ensure the estate has enough liquidity. Final expenses. The cost of burial, cremation, and funeral services. Derek estimates he'll need $20,000 for these. Tax liabilities. Deemed disposition of capital assets and deregistration of registered assets can result in a significant tax bill. In Derek's case, the tax liability on the cottage is $78,750 based on its current value, but this could increase as the cottage appreciates. Debt elimination. Ensuring the estate can pay off all debts. Derek wants his $309,912 mortgage and $41,000 car loan paid off. Estate expenses. This includes probate fees, executor compensation, and legal fees. Derek has no provision for these as his brother will act as executor without compensation. Emergency fund. A family should have an emergency fund of 3 to 6 months of expenses. Derek and Becky have a sufficient fund now, but they want to ensure $25,000 remains after his death to cover 6 months of Becky's reduced expenses. Education fund. The capitalized value of future education costs can be included in the analysis. Derek wants to set aside $10,000 for each of his 3 children, for a total of $30,000. Estate equalization. Life insurance can be used to ensure an equal distribution of assets among children, especially when certain assets, like a cottage, are left to only one child. Charitable bequests and legacies. The analysis can include lump sums for charitable donations, scholarships, or a down payment for a child's home. Derek wants to donate $100,000 to a local hospice center. Total capital needs. Once all needs are identified, they are totaled. Assets available upon death. The next step is to identify all assets available to meet the estate's needs. Many of Derek's assets, like his RRSP and DCPP, are not intended to be used for estate needs as Becky is the beneficiary. The house and cottage are also not liquid assets. Existing insurance. A summary of existing policies should be made. Derek has a $250,000, 10-year term policy and a $100,000 group life policy through his employer. Shortfall. The final step is to determine the capital shortfall, total capital needs at death, available assets plus existing life insurance. This shortfall represents the additional insurance needed and is usually rounded up. Making the recommendation once the numbers are crunched, the agent can recommend a suitable policy. Duration of risk. The duration of each capital need helps determine if term or permanent insurance is needed. Term insurance is suitable for needs with a limited duration, such as a mortgage, children's needs, or income replacement until retirement. Permanent insurance is better for long-term or lifelong needs, like support for a special needs child or a tax liability that will arise upon death. Based on Derek's needs, he would benefit from a combination of term and permanent insurance. Investment needs. If a client has maximized their RRSP and TFSA contributions, a whole life or UL policy could be an option for tax-deferred growth or wealth transfer. This is not the case for Derek and Becky as they are not maximizing their RRSPs and only contribute to their TFSAs with bonuses. Cash flow versus premiums. There may be a trade-off between the ideal policy and the client's cash flow. If cash flow is limited, permanent insurance may be unaffordable, but a term policy with a conversion option could allow the client to convert to permanent coverage later. A UL policy might be a good choice if cash flow is generally adequate but fluctuates. Coverage for spouse or dependents. The spouse and children can be covered under a joint policy or a family life rider. Derek wants $150,000 on Becky's life and $10,000 on each of the children, making the death benefits. Derek needs a total of $760,000 in additional insurance. $200,000 of permanent whole life insurance to cover the estimated tax liability on the cottage and the $100,000 hospice donation. Selecting the paid-up additions, PUA, option for dividends would provide further protection against increasing cottage values. $180,000 of a Term 10 policy to cover the child support and car loan. The remaining $380,000 could be covered by a Term 20 or a renewable Term 10 policy. A cost analysis shows that a combination of a $180,000 Term 10 policy and a $380,000 Term 20 policy is the most cost-effective option over 20 years, with a cumulative cost of $61,850. Premiums. The total monthly cost for the recommended additional insurance is $956. This is more than the $440 the family has available. They can reduce the coverage, use term insurance with a conversion option for permanent needs, scale back on other expenses, or Derek can try to quit smoking to get a lower rate. Beneficiaries. The agent can recommend who should be named as the beneficiary. The applicant must name one or more primary beneficiaries. The estate can be named to pay taxes, or a spouse can be named to provide income. If minor children are beneficiaries, a trustee should be named. Contingent beneficiaries should also be named in case the primary beneficiary dies before the life insured. Naming a trust as a contingent beneficiary can keep the funds out of the estate and avoid probate fees. In most Canadian jurisdictions, beneficiary designations are revocable unless stated otherwise. However, in Quebec, a spouse's designation is automatically irrevocable unless specified otherwise. Naming the estate as a beneficiary means the death benefit will be subject to probate and becomes a matter of public record. Highlighting important clauses. When reviewing the policy, the agent should highlight key provisions for the policyholder. Exclusions. The client should understand any exclusions that would prevent the death benefit from being paid, such as travel to a specific country. All policies have a 2-year suicide exclusion period. Incontestability. For the first 2 years, the policy is contestable, meaning the insurer can reevaluate it and adjust premiums, add exclusions, or void the policy if a material mistake was made. After 2 years, it becomes incontestable and cannot be canceled for any reason other than missed premiums or fraud. Grace period. Policies have a grace period, usually 30 or 31 days, for premium payments. If the life insured dies during this period, the death benefit is still paid but is reduced by the outstanding premium. Reinstatement. If a policy lapses, it can often be reinstated within 2 years by providing proof of insurability and paying missed premiums plus interest. Reinstating an old policy is often better than buying a new one because the premiums are based on the younger age at which the original policy was issued. Right of rescission. The policyholder has a 10-day free look period to review the policy and return it for a full refund of all premiums paid. Expiry. Term policies have an expiry date, and coverage ceases at the end of the term unless it is renewable. Surrender charges. For universal life policies, the agent should ensure the policyholder understands any surrender charges that may apply if the policy is canceled or a partial withdrawal is made. Using illustrations. Illustrations are used to help clients understand the recommended policy. For permanent policies, illustrations include projections of future dividends, mortality deductions, investment account values, and cash surrender values. These are for demonstration purposes only and are not guarantees. The client is usually required to sign the illustration to acknowledge they understand its limitations. Agents may also use simple spreadsheets to compare different options.